Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I'm going to look at some of the ways that small investors get destroyed in the stock market. And it happens time and time again, and it goes through cycles. And I think that if you're cognizant of these things as you go through your investing journey, whether you're just getting started or you're just scrapping pennies together to get some investments, you should be commended for your efforts for beginning in the investing world. But there are a couple traps that are easy to see in hindsight, but they're not always easy to understand when you're going through them, and that's what we're going to cover today. Reminder as always that my stock picks and projections are just my opinion for your entertainment. Please make sure you do your own research and due diligence before investing in any stock. And of course, if you like stock market analysis and personal finance videos, then please make sure to subscribe to the channel. Thank you to everybody who has helped the channel grow. All right, the first thing that's always going to hold you back as a small-time investor, or any investor for that matter, is a lack of savings. Not having a cash savings account, not only to help you through emergencies, but help you when opportunities come up, is really going to restrict the amount of gains that you're able to make in the stock market. If you don't have any savings, and hurdles come up in life, whether it's a broken pipe at home or a car repair or whatever it is, if you don't have that cash that you can access, at least at a reasonable level, then your first intuition is going to be to sell out of your investments, which is going to take away essentially the whole point of investing, and that is to get rewarded through time. The other scenario that will happen if you don't have savings is that an investment that you really like will go through some ebbs and flows, right? It'll have its high days and its low days. And being able to buy at those low days is a big part of what we call dollar cost averaging over the long term. So if you have Microsoft stock and it's doing well, but all of a sudden there's some economic problems that come out in the world, Microsoft stock could go down even though there's nothing really wrong with the company. And if you can't take advantage of that discount, then you're missing a huge opportunity on the lifespan of your investment. So before you ever put $1 in the stock market, please make sure that you have a decent amount of savings, certainly at least enough to cover an unexpected car repair or unexpected medical bill that might come through, because ultimately this will help you avoid taking money out of your investments. Okay, the next thing that comes up with small investors who don't have a ton of money that ends up killing them across the long term is taking sort of risky behavior. And this website, Money Crashers, is like a personal finance kind of magazine, right? Where they just have facts and lists and things like that. It's kind of fun to read sometimes. And they did this whole thing about feeling poor and what it ends up making you do in terms of managing your money. And I think the biggest thing that resonated with me was that feeling poor often leads to risky financial behavior. And I'll just pull one quick paragraph here. In another study done by Payne himself, who was like a New Yorker author, participants were allowed to place a series of bets. They could choose either a low-risk, low-reward option, such as a 100% chance of winning 15 cents, or a high-risk, high-reward option, such as a 10% chance of winning $1.50. When participants were told ahead of time that the most successful players won much more money at this game than the least successful ones, they were much more likely to choose the risky bet than those that were told there was little difference between the players. In other words, just knowing that there's a big gap between winners and losers makes people more likely to take risks. And the point there is simple, right? It's like you don't have a lot of money, you're trying to get into the stock market or into investments because you are hoping to turn your financial fortunes around, which is admirable. But in almost every case, this is a long-term journey that requires you to continue to add into your investment portfolio. Trying to get like a $500 deposit and turn it into $1 million in the stock market is very, very unlikely to happen. And then if you do take that $500 and invest it in a risky stock or other investment strategy, and then it goes bad, we're right back to what we talked about in step number one, which is you have no savings, you lost your investments, and now you're forced to scramble to find enough money basically just to live your life. The real key to winning at this game, even as a small-time investor, is to get in and continue adding in super safe stocks. You can do more research on things like index funds or ETFs, which are basically collections of stocks that have a lot less downside and a lot less cost to owning. And the key there is, you put in, if you have $500, you put in, your first 100 in your ETF, then your second, then your third, slowly over time, and then you're saving on the back end of that. So ideally, at the end of the $500, you've already saved up another $500 somehow. And then this allows you to keep adding to your position over time. And that is truly how money grows. All right, the third biggest killer for small-time investors, in my opinion, is selling at the bottom and buying on the way to the top. So, the simple strategy in the stock market is to buy a stock for a low valuation or a low price or a good opportunity, and then sell it when it reaches its top or when you're ready to cash out after it's made money. What happens, though, inevitably, is the stock market has different ebbs and flows, as you can see on this chart. This is an ETF chart of the S&P 500, and it just basically mimics what the stock market has been doing. This chart runs back to October of 2018, and you can see these ebbs and flows here. And the ideal investment is to get in, say, down here, when the stock market or the economy is at a low point and people aren't interested as much in the stock market or they're fearful, and then you let it sit or you continue to add to positions, and eventually it ends up here or here or here where we are today, and you've made money. But notice across that journey, there's several dips along the way, right? That is going to test your confidence, that is going to test your savings account, because the economy is going to go down, jobs are going to be tough to find, the dollar will weaken, inflation will go up, all these bad things are going to happen naturally over time, just like this, which is the COVID pandemic time. And unfortunately, that is a part where people get scared or they have a life crisis that forces them to sell out here at the very bottom. So pretend a person invested here in this ETF for $301, and they had some dips and valleys, but ultimately they saw it go up to $337 across whatever that is, 6 months or so. But then all of a sudden, we know what happened this year with the pandemic and huge drops. And all of a sudden, that stock went down to $228. And if you freak out, you say to yourself, holy cow, it's going to go down even more. And then you've sold out and you've actually got a net loss on your investment. And what could make that situation even worse if you don't have a savings account is the pandemic might lead to job loss or unexpected medical bills or things like that that put financial hardship on you, and you're forced to sell your stock for a loss because you need any money that you can get. Whereas someone on the other side of the coin who has a solid savings rate and understands that they should keep buying into the stock market even when it crashes because that's when the deals are, they're buying in. They may have invested over here, right? 275. Let's say they got up to 337 and then they dropped, but instead of selling, they're like, oh, good, stocks are on sale. So I'm going to keep buying in the best that I can during these hard times. And the only reason they can do that to appreciate these gains here is if they have a savings account or a backup strategy. It is not easy to find money in times like this when everything's at the bottom. Nothing feels good. There's not a lot of people spending or giving out loans. So unless you have that money saved up somewhere, it's going to be difficult for you to participate in these types of opportunities. But if you do, you can see what happens. Things go back up, and in the investing world, we talk about cost basis or dollar cost averaging. So even if your average purchase price was $337, as soon as it dips down, you should immediately think, oh, I need to lower my average cost. So when you originally purchased, your average price was $337. When you bought low, your average purchase price all of a sudden went down to $275. And then if you kept adding even slowly at a pace through the pandemic, eventually your average price would fall down. And then you get to where we are today. You're already in profit territory from the time before the pandemic when you got in at $337. That's how the game is played. But without savings and some financial security, it's going to be hard to play that game. All right, and the final way that the stock market tends to weed out small-time investors is that everything I just talked about happens in cycles. It's not just a 2020 thing. It happens every couple years that there's a major stock market decline and people sell out at the bottom, they lose money, they call it a scam, and they don't invest anymore. So they go through their whole life without saving or potentially buying into some other tricks or scams that never work, and they miss out of the returns they would have had simply by keeping their money where it was, even though things look bleak. So I hope this gives you guys some perspective, if you're a small-time investor, of the sort of conviction and will that you have to sit through to make it through the stock market's ups and downs. But I want to put emphasis on the first point here. If you don't have your financial house in order, at least to some degree, if you cannot afford a car repair payment, a child care bill, a hospital bill that comes in and sets you back, the number one thing you can do right now is focus on fixing your financial quality of life before investing. Even if that means saving $1 a day in a savings account or going out and starting a business, getting new income, because the stock market, it's very unlikely to provide you with a $0 to $1 million strategy if the amount you have to invest is, say, under $10,000. It's an accumulative game. So even at $10,000, the goal would be that you have financial security in case something does go wrong, and you would continue to add to that $10,000, keeping it invested over time. All right, I hope this was helpful in motivating some of you on the right way to get in as a small-time investor and some of the things that you have to watch out for. Please give me a like and subscribe if you enjoy videos like this. We'll see you on the next video.